I don't think people understand the dangerousness of this moment, because what's going to happen is, in order to make everything work the way the powers that be want it to work, they're going to do exactly what they did during the GFC and exactly what they did during COVID, which is create the circumstances where the wealthy get even wealthier.
Q4 has kicked off with a bang. The government is shut down and the market loves it. The bulls are back and running fast. Hello and welcome to Milk Road Macro, the podcast that knows that Uptober is just a meme, but so far it's a lot more fun than Rectember. I'm your host, John Gillen. Today is Monday, October 6th, and we are joined today by one of the best analysts in macro, Mel Mattison. Mel is a writer, investor, and former fintech executive with over 25 years of experience in finance. Mel studies history carefully and has been one of the most accurate predictors of the market in macro all this year. Mel is going to give us the alpha on everything to watch out for in Q4, so if that sounds good to you, make sure that you like, subscribe, share this episode with someone who's going to enjoy it. And as a reminder, our Milk Road Macro Pro team writes a monthly report on what's going on in the market, breaking everything down. This month's report is called Running It Hot. What does that mean? What do you need to know as an investor to navigate that successfully? Join our pro community today to get in on the alpha there. The link is below in the show notes. And without further ado, welcome to Milk Road Macro. Mel, how are you, sir?
Doing well, and thank you for having me, John. I appreciate it.
Well, I'm excited for this conversation. I'm glad to get you on the show. I wanted to start out with a high-level view of the markets from you. You've described the current trend we're in as an everything, everywhere, all at once type of rally. Give us your outlook on the macro picture right now. What's the framework you're using? What are you seeing in the markets right now?
Yeah, exactly. And I think you can look at things from, a long, short, or long, medium, and short term, right? Long term, that's exactly where I'm at. And everything, everywhere, all at once rally. And that's, bonds, stocks, gold, Bitcoin, real estate. I mean, you name the asset. And what's happened, and this is something I've been talking about, literally for years, calling for 7,000 S&P, 4,000 gold on April 10th, like at the bottom. If people went back to my Twitter, like I was literally like, this is the buying opportunity of the decade, like literally at the bottom. And I'm like piling into things. I'm buying like EEM calls for like 40 cents that are now worth like $7. And I'm like, these are going to be some of the best trades of your life. And they were for me. I mean, this year has just been incredible. And it was because I had this conviction, this belief from the very beginning of the year. In December, I was like, this market's toppy. There's going to be a correction, 15, 20%, but it's going to be short-lived. And then we're going to go on an epic bull run. It's going to be ridiculous. It's going to be like 3 different decades. And we could put it in the framework of 3 different decades, the 20s, the 90s, which have been talked about a little bit. But in many ways, I actually think the most similar decade is the 50s. And a lot of people don't bring those correlations to the 50s. And a lot of people don't understand what the market did in the 50s. People think the 90s were a great market. Well, the 50s were even better. In the 90s, the average return on the S&P was 18.4%. In the 50s, the average return on the S&P was over 19%. So when you look back and you say, and this is the other thing that really gets me, and I hate this. I totally hate this. All these old guys that are like 80 years old say, this isn't how the market works. This isn't what happens. I've been in the market for 40 years, and this isn't what happens. Guess what? The market's a lot older than 40 years. And just because it didn't happen in the 60s, 70s, or 80s, doesn't mean it didn't happen in the 20s. Doesn't mean it didn't happen in the 50s. And so I'm not saying this time is different. I'm actually saying this time is like all the other times. It's just all those other times are not in investor lifetimes. Even the old bulls of Wall Street, even the 80-year-old Warren Buffetts have never seen what we're seeing. Because Buffett, he was like 20 years old maybe in 1950. So maybe he saw a bit of the 50s, but he wasn't really in the market in a big way. So what we're seeing is market action that has happened many times before, but not in the living memory of even our oldest investors. And so our oldest investors are sitting back and saying, this is the biggest thing that's happened. All the big correlations are breaking down. Gold to the dollar breaking down. Unemployment rate to GDP breaking down. Like these are fundamental paradigm shifts that tend to happen over 40, 80-year interest rate type cycles that people are looking back and they're saying, when X happened in 1970 or 1980, then Y happened. Therefore, X is happening now, therefore Y is going to happen. Yet if you say, actually, when X happened in 1920 or 1950, then Y happened, which is a completely different Y than the Y from 60 or 70. And so what we're seeing in like is it's just incredibly different. It's a paradigm shift. It has to do with interest rates. It has to do with the bond market, which is the center of everything. It has to do with what's now being called the debasement trade, which is scaring me because I'm hearing it on Bloomberg and I've been talking about it for years. And now people are saying the debasement trade like it's some new trade. You know, and I'm not the only one. You know, guys, Warren Pye's had talked about it. Luke Groman, like Larry like everybody. There's such a huge kind of X cohort of people that have literally been talking about this for years. And the scariest thing to me right now is that Morgan Stanley and Goldman Sachs are saying the same thing that I was a year ago.
Well, it's always nice when they finally catch up. Mel, this is one of the reasons why I wanted to bring you on, right? Like you're such a student of history that you have a much different perspective, and that enables you to make calls like you did at the April lows and at the end of December of last year. So I really appreciate that insight and that history lesson. That's a really helpful perspective. I wanted to ask you a question about this. Last week, I had Jordy Visser on the podcast. It was a great episode. So if anyone missed that, go back and look at it because Jordy dropped a lot of alpha about AI and many other things. But one of the things he emphasized was this idea of concentration of investment, that this bull run has been in a few key equities, but not really broadly across the S&P. It's been in gold, it's been in Bitcoin. But a lot of investors are wondering, is this going to stay concentrated as we go forward, or is this going to broaden out into the rest of the market? What are your thoughts on that? How do you see that playing out? Do you agree that the investment and the economic activity in this bull run is going to stay very concentrated as we go forward?
Yeah, I don't think it's necessarily going to stay concentrated. And I think there is, although it's just beginning, there is a changing of the guard of SaaS going from the top of the hill to not necessarily the bottom, but somewhere mediocre. And when I say SaaS, I mean software as a service. And this has to do with the fundamental devaluation in the importance of coding, right? And this is AI, and that's why I did watch your interview with Jordy. I would say that like 1 or 2 years ago, so I had actually never listened to people on YouTube until I left financial services. I worked 25 years in financial services. I was the CEO of 3 different SEC FINRA regulated broker dealers. I worked primarily in private markets. I was instrumental in kind of really breaking through how do we take private shares in these large public companies and disseminate them to the public at large. So I worked for 3 different companies, SecFi, EquityB, Vested. All of them, what we did was we pioneered innovative ways, not to get into the details of it, but it was through these antiquated prepaid forward contracts that went back to the railroad era to essentially be able to take these private shares and kind of disseminate them out. And I worked with FINRA and the SEC to pioneer. This is kind of how I, made what I made so that now I can trade and do what I want to do. But basically, pioneering this. So I understand that market, and I understand what Robinhood is doing, which is one of my favorite stocks and biggest holdings, and what Vlad's doing. And I understand what tokenization is doing, which if we want to get into, which is a huge thing that's going to disrupt the markets, the tokenization of equities, and other assets. But there's just so many amazing things happening. And so when I look back and I think, what type of an era is this like? Like I really do think of industrial revolution. I think of railroads. There's a great story. There was some small little like seaside village in England, that had like 20,000 people living in it. And at the peak of the railroad boom, like 3 companies were building railroad lines from London to this village. Like there was no way that there needed to be 3 railroad lines from London to this village of 20,000 people on the coast. And yet they were building it because railroads were so transformative. And I think AI and railroads are a great corollary. You think about what the world was like pre-railroad. You want to go from New York to San Francisco. Best thing you could do is get on a boat and go all the way under Argentina, like a 15,000 mile multi-month sea journey that then gets cut to like 1 or 2 weeks on a railroad, right? Across land. Because otherwise you were taking oxen, you were taking horses, you had these insurmountable mountains, you had Indian attacks, the entire world changed with the railroad. And people got so into it, and literally we had these barons, right? It's very similar. It is eerily similar. Rockefeller, Carnegie, Vanderbilt, like these types of individuals, Ellison, Musk, Zuck, like, so we're going through this big shift. And it's like you go back on these 80-year time frames, there's a tie into the financial history, and you say, okay, what is this decade kind of like? And I think if you really look, and this is why I love the 1950s as a corollary, I think we had 2 big events in the 40s, 50s, right, that affected the economy and the world a lot. We had World War II, which I would equate to COVID. And a lot of people forget about this, but we had the Korean War, which I actually kind of equate to the GFC. And those happen in reverse order. World War II was before the Korean War. So for people that don't know about the Korean War, it was 1950 to 1952. There was a very big recession in the United States in 1953. I talked about the 1950s being a better decade for equities than even the 90s, an over 19% average return. So when people say we can't have 20% returns for 10 years in a row, bullshit. We had it in the 50s. Don't tell me like, oh, this can't happen. Like we people are going to say, well, Mel, what are you saying? We're going to have 10 years of 20% returns. We're going to have a decade straight. We did it before. Maybe not in any recent investor's lifetime. Maybe Jeffrey Gundlach doesn't remember it, but it happened. It happened.
So you think that this rally that we're seeing from AI will eventually broaden out into the rest of the market? Is that what I'm hearing you say?
Yes, and not even so much so, but I lean towards some of Visser's leanings that this is maybe destructive for some of the monopoly type power that some of these Mag 7s have. And so I think that ironically, at the same point that people came to accept index funds are the best, that's when index funds are going to hurt people. When people are investing in, oh, well, you know what? Who can beat the market? Bullshit. I beat the market every fucking year. Look, the market is not hard to beat. Warren Buffett said it. Warren Buffett has said himself, it's easy to beat the market if you don't have to move around $500 billion in capital. Like people that want to tell you, you know what, it's impossible and Bogler and you want to invest in the SPX and SPX is up like 12%. I mean, I'm sorry. People can look at my chart. I'm up like over 100% this year on $1 million plus portfolio. This is ridiculous. Like you want to be up 12% in this type of a market? You're nuts. You're absolutely nuts.
Well, I think it's helpful again to get the history lesson on this, and there's a lot of opportunity out there. I want to kind of pivot this conversation in a little bit of a different direction. You brought up the debasement trade and how a lot of people are starting to pick up on this now. At the center of all of this, and like what's going on with the dollar and the bond market, is the Federal Reserve. And something you've been pointing out that I think is something a lot of people have been missing is that traditionally the Federal Reserve is said to have a dual mandate of price stability, so like controlling inflation, and low unemployment. But you've been very vocal about pointing out that the original act of Congress that created the Federal Reserve in 1913 actually had 3 mandates listed. And a lot of people are saying that the Trump administration might want to start bringing this back. Could you tell us what is this third mandate, and what would the impact on the market be if the Federal Reserve starts to have a third mandate instead of those 2 that it's had for so long?
Yeah. So, and this is one of the things. Actually, I think Jim Bianco made a tweet on this over the weekend. There was some comments made, Nick Timmeros or some other people, basically, like, I think it was Wall. I don't know who it was, but they were trying to point back to the purview of Fed monetary policy in like the 20s and 30s. And the point Bianco was making, and a lot of times I disagree with him, actually. I think he's a nice, very smart guy, and a lot of times he makes good points. Sometimes I think he makes bad points. He notably thought the Fed was making a policy mistake and there's no problem in the labor market. I think there is a problem in the labor market. He said basically the only reason the labor market wasn't creating more jobs is because immigration stopped. But I'm digressing there. The point is that the Federal Reserve has a very specific mandate that was revamped, refined during the 1970s under the Carter administration. The official name is like the Balanced Employment Inflation Act or something. It's colloquially named Humphrey Hawkins. But when people look at it, it gives 3 specific mandates for the Federal Open Market Committee. And again, I'm being very specific here. I'm not saying for the Fed. I'm saying for the Federal Open Market Committee, because the whole way the Federal Reserve used to set interest rates is very different over the decades. You used to have one interest rate set by the Reserve Bank of Chicago, and that could be different than New York, could be different than Richmond, could be different than Atlanta, could be different than St. Louis, so all of these things are changed. So to go back and say, well, this is what we did in the 20s or 30s is absolutely insane. It's insane that we don't have the Federal Reserve of the 20s or 30s. We have different laws that were put in place in the 1970s. So you can't say, well, we did this in the 30s, so therefore we should be able to do this in the 2020s. No, you have to say, what can we do under the statute? And under the statute, the FOMC has 3 distinct mandates, and they are manage unemployment, price stability, and make sure that long-term interest rates are moderate. And it's very clear in the mandate. It's not like not listed. It doesn't say this is like, something to the side that you shouldn't really consider. And I started talking about it like a year ago, and nobody else was talking about it. A couple of people might have on X, but nobody in mainstream media. And then Moran brought it up, and he said, Mirren, I believe is how actually I pronounce it. Mirren brought it up and said, look, moderate long-term interest rates are just as much as our mandate as is unemployment, as is price stability. So it's there in the law. And Powell, I thought, got dangerously close to a removable offense in the last press conference when he basically said, well, we don't really consider it because if we take care of price stability and unemployment, we'll take care of it, moderate long-term. Well, that's not for him to decide. Congress said these are the 3 mandates. You could just as easily say, well, if we take care of unemployment and moderate interest rates, inflation will take care of itself. That's a judgment call type of a decision that is not left up to the discretion of the chair of the Fed. The Federal Reserve is mandated to maintain moderate long-term interest rates. Anybody that says, well, the Fed only controls the short end of the curve does not understand history. And again, I'm going back pre-Humphrey Hawkins, and this is why I love the 1950s as an example, is we had explicit yield curve control, right? So we had a period where the government said, and it was not until the 50s that it was really lifted. It was the 1952, it's called the Fed Treasury Accord, where essentially the Treasury said, okay, Fed, we're going to give you some independence again. But one needs to remember that Fed independence is a gift from the executive and legislative branches. It's not something guaranteed constitutionally. And so at any point in time, the executive and the legislative branches can change the mandate of the Fed. They can do anything they want to the Fed. The Fed is not like, it's not like Article 8 of the Constitution establishment of the Federal Reserve. In fact, the central bank is something that from Jefferson to Andrew Jackson over history, Americans have radically opposed, because essentially what happened in the beginning of our government was we needed funding. And the way the United States used to fund itself was absolutely ridiculous. We used to like create bonds and then try to sell them in the open market ourselves. And we often sold them at 40, 50% haircuts. Like the US would issue $1 million in bonds and we'd sell it for 600,000 in the market. And we said, this is ridiculous. And what happened is a bunch of because in the beginning of our country, all the money was in Europe, a bunch of very wealthy European bankers said, let us create a bank. And make no mistake about it, the first central banks in the United States were more or less owned by Europeans. They said, we will manage your debt and we'll lower your spread between issuance and actually achieved income in cash. And we needed it. And why did we need it? Because the world was on a gold standard. I mean, because you couldn't just print the money. We can now print. There's actually no need for the Federal Reserve. The Federal Reserve is anachronistic. The Federal Reserve actually perhaps hurts the country more than it helps. I think that getting rid of the Federal Reserve, the End the Fed movement, is considered kind of very right-wing nutso. I think in the coming years, it might become more mainstream, and people might say, why do we have a Federal Reserve? What are they doing? Because at the end of the day, and this is what people need to realize when they look at that symbol that Powell talks in front of, it doesn't say Federal Reserve. It says Federal Reserve System. System is the key, because what it is was when it was set up, Creature from Jekyll Island, all this stuff, F.W. Griffin, everybody knows the history that really follows this stuff. This was created by bankers. And who owns the regional banks? The regional banks, literally the shareholders are JP Morgan, Citigroup, Morgan Stanley. It's like it is technically owned. Even the Supreme Court, when they said, we can't necessarily equate a Federal Reserve to an independent agency because the Federal Reserve is a quasi-private entity. That was a polite way of saying that it's owned by the banks. So that's the reality of the world we live in. The Federal Reserve is owned by the banks. It's not some independent government agency.
So this is a very long answer to the question, but I wanted to let you run on that because I think there's a lot of information in there, the context, the history, that's really helpful for the audience that they may not have gotten from other sources. And I think that it's really important for investors to know about. But bringing this back to the present day, you talked about moderate long-term interest rates being part of the Fed's mandate and how the Trump administration is starting to bring that back into focus. You mentioned yield curve control. Tell our audience what yield curve control might look like and what might it look like for the market if the Federal Reserve starts to pursue that policy path again, like they have in the past, and what might they do to actually apply that or to try to get to moderate long-term interest rates?
Yeah. So I think what they're going to do is that there's no way that they can let interest rates get out of hand. And in fact, this morning we're seeing French yields go up. And this is the problem. And this is a huge problem in Europe. Is the euro is a fundamentally flawed system. The fact that France cannot print its own currency or Germany cannot print its own currency. It wasn't that big of a deal when it was Greece that was in trouble because the ECB could just create the bazooka and handle Greece. But when you're getting to France and Germany, like there's a problem. France and Germany, and this goes back right to the 50s, right? So we had in the 50s a recognition. There was a brief period after World War II when we were still kind of frenemies with the Soviet Union and Joseph Stalin, where we kind of thought we could just let Europe be on their own. And what we realized as the United States, and this is what led to the Marshall Plan, was if we don't support, essentially through money printing and helicopter drops, Europe, Soviet Union is just going to run over Europe. That we just fought this huge war to stop some dictator from taking over Europe. And what we're going to do if we abandon Europe at this point in 1945, 1946, is some dictator is going to take over all of Europe, but instead of Hitler, it's going to be Joseph Stalin. And and we did the same thing in Japan. We did a very similar thing to the Marshall Plan in Japan. We're doing the exact same thing now. And guess who are the enemies? Japan, worried about China. At the time, Europe was worried about Soviet Union, aka Russia. And I think at the end of the day, these are where the fault lines are going to land. And so as much as the Europeans might not like Trump's personality, we just had a huge win for Trump with the prime minister in Japan this weekend, Takaichi, first female PM. The Nikkei soared like over 4% last night. You know, the Cold War lines are just completely being redrawn. It's Marshall Plan. It's the 1950s all over again. And it's Russia and China on one side, same thing in the 1950s, United States in the middle with Western Europe and Japan on the other sides, and then kind of a ancillary conflict type things going on in Latin America, which we also had at that same time. Many people don't realize that many South American countries sided with the Axis, right? Brazil, most Nazis, when they left Germany, they went to where? Argentina. So South America has always been a fulcrum point. This is one of the reasons why I love EWZ, the Brazil equities. I think that South America is like, I would call it like Joe Manchin, like they're in between, right? They can go either way. And because of that, they're going to get favored treatment eventually. They're starting off getting tough treatment. Trump really raised tariffs on Brazil. Why did he do that? Because Brazil is so important. Brazil is, if we didn't have Alaska, Brazil would be a larger country than the United States by land. Brazil is a huge rare earth. Brazil has labor. Brazil has energy. There was some future movie, I think, and the capital of the world was in Brazil. Like Brazil is like, it has so much. That's why I love Brazil. I like one of my biggest calls at the beginning of the years was EEM over SPY. And a lot of people thought that was crazy. Like, why would emerging markets outperform the US in the era of American exceptionalism? And I was like, people don't understand how great this is for emerging markets. Like emerging markets, I think the run is just beginning. I think it's like $53, $54 a share right now on EEM. It's going to be $70 a share in 6 to 12 months. I mean, this is where the alpha is in these types of areas. I like my biggest bets are Bitcoin, gold, EEM. Like I really don't play that much in the U.S. to be honest with you. I a lot of times I'll post things on X about the SPY or Qs, but like those are very small positions to me, because to me the big alpha is outside of the U.S. and it's in gold and Bitcoin.
And I wanted to just come back to the question about what does it mean if the Federal Reserve starts doing yield curve control? Yes,
exactly. So what does that mean? Great for emerging markets, right? Because what is the big drag on emerging markets? It's the currency. It's the fact that emerging markets have to typically.
No, I mean, like, what does it mean? Like, what does that mean that the Federal Reserve is going to start buying more bonds in the open market? What does yield curve control mean? Like, what would they actually start doing?
Mechanically,
yes, right.
Yeah. Okay, so number one, the first thing that they should do is get rid of this QT, because there is no reason for them to be rolling off their balance sheet. And I have done research on this, and looking at the size of the Federal Reserve balance sheet relative to U.S. debt outstanding. So if you just look on like an absolute basis, you look at the Federal Reserve balance sheet, we reached over $9 trillion on the Federal Reserve balance sheet at the peak of COVID, and we have rolled off over $2 trillion. Now, one thing I would like to mention to people, that's more than all of the treasury holdings of China and Japan combined, right? So when people talk about, well, these foreigners could start selling treasuries, the Federal Reserve has basically sold more treasuries than China and Japan hold. So there's no threat there's no threat from China or Japan selling treasuries. When people talk about, well, China or Japan could start to sell treasuries, there's no threat from that. It's a very, very small amount. People have to understand the amount of outstanding treasuries there are and what's held by foreigners. They need to look at tick data. They need to look at, where is the money? So I've looked at over the decades how much U.S. debt is held by foreigners, how much is held by the central bank, how much is held by U.S. holders. And right now, we are in a situation where we actually have more debt held by foreigners than we typically have. In other words, if foreigners continue and keep selling or not buying treasuries, we're just getting back to norms. That's actually what we want, because and the reason why we want that is because interest payments are stimulus. I call interest stimulus. I call it interest stimulus. So if we're paying 4% on a 10-year, we don't want that 4% going to China. We want it going to a mutual fund in the U.S. that is owned by a pension fund. We want it going to a bank. We want it in the U.S. We want it going to the Federal Reserve, which then just recycles it back to the Treasury, which essentially means it's not really an interest payment, right? So the key to managing this massive debt load, and this is the failure of imagination of people like Elon Musk, and this is what I think people need to really step back from their areas of expertise, and where a little bit of knowledge can hurt a lot. There's a lot of very smart people like Elon, Colonel Douglas McGregor. I could all over the sphere of influencers that think they understand finance, and they're saying that the U.S. debt is a problem. And I don't think they understand that the U.S. debt is not a problem at all. It's an easily manageable situation, easily manageable. And so to handle this, all we need to do is have the Federal Reserve buy treasuries. All we need to do is have banks load up on treasuries on their balance sheet without affecting its leverage reserves. All we need is stable coins. And when people say this is what's going to cause inflation, no, it's not. Because, and in fact, you had a guest, Henke, a great economist. He said people look at interest rates, debt levels. That's not what's important. What's important is the growth of the money supply. Part of the growth of the money supply is velocity. Velocity is extremely small. And what that means is that even though dollars are being created, they're not circulating through the system at a very high level because there's not a huge level of credit issuance. And so there's the potential to substantially increase debt levels, stash them in these places, and not create 8%, 9%, inflation. And so the fact is, just like Japan, which has like 250% debt to GDP, that has huge amounts of debt, like 100% of debt to GDP owned by the central bank, there's huge potential for the Federal Reserve to absorb Treasury issuance. So the Federal Reserve could conceivably, take their balance sheet from 9 trillion, it went down to 7 trillion, could, I think, conceivably easily take it to $20 trillion in the next decade without creating massive inflation. And that's completely against consensus, because what people say, that's money printing, they're putting it on the balance sheet. The reason we had inflation post-COVID was not because of the debt that was printed, because it was because what we were doing in COVID was we were literally sending checks to every American. And then in a supply chain constrained environment, we were telling them to buy. So if you literally send out trillions of dollars to Americans and say, go buy goods, because they couldn't buy services because of the lockdown, and then goods are not coming in because ports are jammed and everything else, of course you're going to get inflation. And that's kind of MMT. And that's what MMT offers. And I am a proponent in some regards of MMT, which has a very bad reputation because a lot of people, I think, misunderstand it. And they think that MMT says you can print as much as you want. That's not what it is.
What's MMT before you go on this? I think just define what MMT is, modern monetary theory.
Yeah, modern money theory. It's often called modern monetary theory. Some people, but there's a couple of main guys that really back it, started it. L. Randall Wray, Warren Mosler, and what they do is they basically say that these models that people base things off of are based off of a gold standard system. That and this is the simplest way I do it. They don't explain it this way. I explain it this way. There is a fundamental change in the way monetary policy works in 1971. When money was no longer based off of gold, it became a whole different animal. And to try to look at what happened in the 60s or the 20s or the 30s or in Weimar Germany or in any of these things, it's a completely pointless exercise. Because at this point in time, we do not have a gold standard. We have money that is pure fiat. And pure fiat money, you have to analyze it in a completely different perspective. And what you have to look at is, where does the government create and spend money that then competes with the private sector in such a way that that competition is going to drive up prices? And if you have that scenario, you're going to get inflation. Otherwise, how much money the government creates is relatively irrelevant.
Mel, this is one of the big reasons I wanted to talk to you, to just get, like I said, like this historical analysis and perspective, but also these very non-consensus takes. And whether or not the audience agrees or disagrees, I think it's really helpful to hear alternative ways of thinking about these problems and solutions that could be discussed about them. Really interesting stuff. We're getting close to time already, so I'm going to kind of try to squeeze several questions into one. But you've been very vocal about this idea of the gold war, not a cold war. And for the first time in over 30 years, central banks are now holding more gold than dollar-based debt on their balance sheets. To kind of like bring this together, I'm particularly curious about two assets, but like you've been very bullish on gold and Bitcoin. Both of them, as recently as today, I believe, have been putting in new highs. How long is that bull run going to go for Bitcoin and gold? How high is it going to go? Just walk us through some of your thinking on that, because I think what the audience would really like to come away from this with is not just a history lesson, but like, where's the bull run going? Where's the top going to be? And just what are your thoughts around that?
Well, very short term, I think we're actually getting to a point where gold is due for kind of a little bit of a rest. Very short term, and maybe I'll put out an X post on my charts and why I think about that. If people want to go to Mel Mattison 1, I'll do that later today. But basically, longer term, this is, in my opinion, just getting started. Like, this is, people do not understand. I mean, Lou Groman talks about the need for gold to go over $20,000 to equalize China's trade balance. Do I think gold's going to $20,000 in the next 2 years? No. Do I think it's going to $20,000 in the next 10 to 15 years? Yes, absolutely. Gold, what's happening, and this is, it might seem antithetical to what I just talked about we're not on a gold standard. But what it is it's the recognition that this fiat system, the way it's currently structured, has fundamental flaws. And this is Trippin's dilemma. This was talked about by Keynes during Bretton Woods in 1944, where he basically said, if you basically just have USD as the reserve currency, it's going to force the dollar to go into total deficit to foreign creditors, because there's going to be this global demand for dollars. It's an unsustainable proposition. It was sustainable, but for 60 years, or no, actually closer to 80 years, but it's no longer sustainable. And so what's happening is people are going back to what has worked before. And what Keynes wanted back then was gold to be part of a not like a strict gold standard system. He thought, so he called it Bancor, which is like a French word for gold. If people want to research Keynes, Bretton Woods, the Bancor, the way he thought about how do you manage international currency dynamics. And he basically believed that USD as the one reserve currency was fundamentally flawed. Later, a decade or two later, an economist, Trippin, came out and kind of really formalized it in what he called Trippin's dilemma. But we're seeing that breakdown. And Scott Besson talked about it at a Manhattan Institute interview about a year ago, where he said, we're going through a reset. I want to be a part of it. This was before he was Treasury Secretary. And China is figuring out ways to essentially buy oil from Saudi Arabia, net settle in gold, do things through the Shanghai Gold Exchange, different things because they have a closed capital account on the yuan. And this whole entire like secondary system is being set up, and it's all based around gold. And why are they basing it around gold? Because gold, it's worked for thousands of years. It has that history. Essentially 1971 to 2020 is basically a 50-year aberration in hundreds of years of history where gold, it just works. It just works. And it's not because, I think part of it is because it's yellow, to be honest with you. No, honestly, because platinum is a better metal. Platinum is more rare, but it looks like silver and, kind of palladium and like the yellow metal. And this might sound ridiculous to people. Well, the whole world monetary system is going to go based around an element because it's yellow. People are crazy. I mean, what do you want me to tell you, John? People are crazy, and it works. And there's two reasons: people are crazy, and it works. And gold works. It can be mined, but it can't be forged. It can do things that Bitcoin can't do. Bitcoin has a trail. There's a decentralized ledger. Gold, Switzerland could send $10 billion of gold somewhere. That country could melt it down, reformat it. Nobody knows where it comes from, what happened to it. Gold has attributes to it that are amazing. Now, Bitcoin I see as digital gold, and that's being accepted. So I think basically what's happening, and these two neutral reserve assets, these are the two things they're going to do. They're going to absorb monetary premium, because the history has been absorbing monetary premium into the stock market and the real estate market. And when you do that, you create really big problems for society. And we did not get into societal problems, which I see as the biggest threat to our economy going forward, is a potential civil war, which could be a whole nother conversation. But basically, I don't think people understand the dangerousness of this moment. Because what's going to happen is, in order to make everything work the way the powers that be want it to work, they're going to do exactly what they did during the GFC and exactly what they did during COVID, which is create the circumstances where the wealthy get even wealthier. And that wealth inequality, which everybody complains is a big problem, is going to get worse, not better, in the coming years. And that's why there is going to be a point where you want to pull back from this bullishness, because there's going to be societal effects. We're seeing it with Mandami. We're seeing it in different places. So Charlie Kirk assassination, all these things. So we are at a point that is, in parlance, a fourth turning. And there's going to be big disruptions happening. In the meantime, the markets are going to run, but there's going to come a point where certain things are going to start to break down. SaaS models are going to break down. Social cohesion is going to break down. And so I don't know if that's 2027, 2029, 2031. But I think that right now the play is to ride the wave. And then there's going to be a point where not only do you want to reduce, you want to just get out of risk. And you're going to want to essentially, even gold, everything's going to go down. And you're going to want to actually just hold cash, because but I honestly think that's at least 12 to 24 months away at a minimum, and possibly longer.
Yeah, so I really appreciate you bringing the history lesson back to the present day there and kind of helping our audience think about these things. I think, what I'm hearing from you is this debasement trade, this chronic systemic issue we have with central banking fiat is something that is starting to become mainstream news and understood. The Secretary of the Treasury knows we're going through a reset and is trying to, be part of that. And yeah, just like you say, like I think a lot of people who are macro analysts can see the storm clouds on the horizon, and the current administration is trying to see if they can, clear those up before we ever get there. Keep kicking the can down the road and come up with some solution to get us through this. But for their audience who's watching this, right, like it's important not to sit on the sidelines during this bull run, but it's also important to pay attention because things can shift quickly. And so it now is a really important time, I think, to be educated, to be nimble, and to just pay attention, basically. Mel, really appreciate your time and the alpha and the history that you've shared with us and our audience. Where can we send people to find more of you and your work online?
Yeah, Mel Mattison 1 on X, and my website is melmattison.com. I also wrote a financial thriller called Quaz, Quoz, Quantum Oz, about a world where AI and quantum computing take over the markets and central bankers conspire to essentially remove the dollar as reserve currency. Basically, it's not Brazil, India, China, and Russia. But, those are great things. One last thing I would add, just really quick, is like in the 90s, and this is why it's important to be nimble and not get out right now, is in the last 18 months, the NASDAQ went from 2,000 to 5,000. And so when you're in these periods that many investors haven't seen, I had already graduated from college at that point. I know I look young, but believe it or not, I turn 50 next month. So I was a college graduate in 1998 and was investing during the dot-com boom. Those were crazy days. And I was working at a brokerage firm, and I was working with guys, and they were buying things, and I mean, they were making insane amounts of money because it was a true bubble. And there's only been really two true bubbles in the last 150 years, and it's really the late 20s and the late 90s. And if you've never lived through one of those, you don't understand what the markets can actually do. And so a lot of people are looking at this market and they're saying it's ridiculous, it can't go higher. And it's like, normally that's true. In a bubble environment, which I think we're heading into, it can go a lot higher and a lot quicker.
Mel Mattison, thank you so much for being on Milk Road Macro. I really appreciate it.
Thank you.
And thank you all for joining us. I hope that you all learned a lot. I sure did. So until next time, stay safe, stay bullish, stay educated, and we will see you all in the next episode of Milk Road Macro. Thanks, everyone. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.